February 18th, 2026, 9:30 a.m. Eastern Standard Time. Look at the clock. The opening bell hasn't even finished echoing across global markets. Bitcoin is hovering just above $52,000. Ethereum is stable. The total crypto market cap is sitting comfortably above $2.3 trillion. Traders are scrolling. Coffee is hot. Charts are calm. Everything looks normal. By 10 a.m. it isn't. 30 minutes later, $40 billion is gone. Erased, not transferred, not hacked, not stolen, just gone. That's more than the annual GDP of some countries. Disappeared before most retail traders could even refresh their screens. And here's what makes it worse. There was no breaking headline, no exchange collapse, no government ban, no rogue CEO boarding a private jet. Silent. When FTX imploded, we knew why. When Terra collapsed, we watched the algorithm unravel in real time. When exchanges get hacked, we can track the stolen coins on-chain like footprints in fresh snow. But on this morning, there were no footprints, no confession, no smoking gun. This wasn't a hack. This wasn't fraud. This wasn't even panic in the traditional sense. This was structural. And if you hold crypto right now, if you hold tech stocks, if you hold anything driven by liquidity, you need to understand exactly what happened in that 30-minute window. Because it didn't just break support levels. It exposed a weakness in the foundation of the market itself. To understand how $40 billion evaporates in half an hour, you have to rewind. The market didn't wake up and decide to self-destruct. It had been bleeding for months. Go back to November 2025. Bitcoin had just printed a new all-time high above $118,000. The narrative was unstoppable adoption. Spot ETFs were pulling in billions. Influencers were calling for $150,000. Retail felt invincible. Institutions looked committed. But price stopped climbing. Then it started grinding lower. December was red. January was worse. Each bounce got weaker. Each rally sold faster. The total market cap quietly slipped from $3.8 trillion to $2.6 trillion. That's not a crash. That's a slow leak. And slow leaks are dangerous because they exhaust hope. Now layer something else on top. Interest rates. Throughout early 2026, the Federal Reserve signaled something the market didn't want to hear. Rates would stay higher for longer. Inflation wasn't cooling fast enough. Cuts were delayed. Liquidity would not return on schedule. Cheap money is oxygen for risk assets. When rates are near zero, investors chase yield anywhere they can find it. Crypto thrives in that environment. But when bonds suddenly offer 5% risk-free, the math changes. The same hedge fund that once allocated aggressively to Bitcoin starts asking a different question. Why gamble for 20% when you can earn 5% guaranteed? That shift doesn't show up in headlines. It shows up in flows. And in the weeks leading up to the crash, those flows were quietly turning negative. Stablecoin supply started shrinking. USDT and USDC redemptions increased. That means investors weren't just rotating from Bitcoin to stablecoins. They were cashing out entirely, wiring dollars back to bank accounts. They were leaving the casino. Imagine a poker table where chips slowly disappear. Players cash out one by one. The room gets quieter. The stack sizes get smaller. Eventually, one large bet can clear the entire table. That's what the crypto market became in February. Thin, quiet, fragile. Then came the spark. At 9:42 a.m., Bitcoin slipped 0.8%. Nothing dramatic, a normal Tuesday move. But in a market starved of liquidity, small moves don't stay small. That 0.8% drop triggered automated sell programs. Stop losses fired. High-frequency bots reacted. Futures contracts started flashing red. Normally, buyers step in. Market makers absorb the pressure. But the order books were shallow. The bids were thin. The safety net had holes. So when the first wave of selling hit, there was nobody underneath to catch it. Bitcoin dropped 1.5%, then 2%. That's when the leverage cascade began. Crypto in 2026 is not just spot buying. It's futures. It's perpetual swaps. It's traders borrowing 10x, 20x, sometimes 50x their capital to amplify gains. Leverage is a multiplier. It magnifies wins, but it also magnifies pain. At 2% down, the first margin calls hit. Traders who borrowed heavily to bet on a bounce were suddenly underwater. Exchanges don't negotiate, they liquidate. Positions are forced sold to cover debt. Those forced sales pushed price lower. Lower prices triggered more liquidations. Within minutes, the cascade was unstoppable. Bitcoin fell 3%. Ethereum dropped 4%. Altcoins collapsed 8%, 10%, 12% in a blink. Over $1.3 billion in leverage positions were wiped out before 10:10 a.m. And here's the terrifying part. The system worked exactly as designed. No glitch, no bug, no manipulation required, just math. Selling begets selling. Liquidation feeds liquidation. In a deep market, this creates waves. In a shallow market, it creates a vacuum. By 10 a.m., $40 billion in market value had evaporated. Charts looked like cliffs. Social media exploded. "Buy the dip," they screamed. Screenshots of limit orders flooded timelines. But something was missing. Dry powder. For months, investors had been deploying capital into every bounce. They had already bought the dip. And the dip before that. And the dip before that. By February, there was no fresh capital left waiting on the sidelines. When the crash began, there was no cavalry coming over the hill. That's why the drop was violent. Not because of news, because of absence. Liquidity isn't visible. You can't see it like price. But when it disappears, the market feels hollow, like stepping onto ice that looks solid but isn't. Around 10:15 a.m., the selling slowed. Short sellers took profits. Price ticked up slightly. Green candles appeared. Relief washed across trading desks. It looked like a recovery. It wasn't. This is the phase professionals fear most. The dead cat bounce. Even after a violent fall, markets can snap back temporarily. Shorts close. Algorithms rebalance. Momentum pauses. But unless new money enters, the bounce fades. And that's exactly what happened. By midday, the market was drifting lower again. Not collapsing, but bleeding. The damage was done. Confidence was fractured. For 5 years, the winning strategy in crypto was simple. Buy the dip. Every crash eventually reversed. Every correction became an opportunity. It was Pavlovian. Red candle equals future profit. February's crash broke that reflex. Investors started asking a different question. What if this time is different? Because zoom out. From the peak in late 2025, the market had already lost nearly $1.5 trillion. The $40 billion flash crash wasn't the beginning. It was confirmation. Confirmation that liquidity was shrinking. Confirmation that whales were exiting. And it wasn't retail driving this. On-chain data showed large wallet outflows to exchanges days before the event. Funds that had been dormant for months suddenly moved. Institutions weren't tweeting. They weren't announcing. They were repositioning quietly. When big money moves, it doesn't panic. It prepares. And what were they preparing for? Higher rates, stronger dollar, tighter credit conditions. Crypto is often marketed as uncorrelated, independent, a hedge. But in reality, it's one of the purest expressions of global liquidity. When cash is abundant, crypto soars. When cash tightens, crypto suffocates. On February 18th, it suffocated for 30 minutes. Now here's the uncomfortable part. Crypto trades 24/7. No circuit breakers, no trading halts, no closing bells. It is the raw nerve of the financial system. It reacts first. It reacts fastest. And sometimes, it reacts violently. If a $2 trillion asset class can lose $40 billion in half an hour because liquidity thins out, what happens in a $50 trillion stock market under the same pressure? The plumbing is similar. High-frequency trading, options leverage, algorithmic triggers, zero-day to expiration contracts. A 1% move can ripple through derivatives like electricity through a wire. Crypto may be the canary, but it's rarely the last bird to fall silent. So what do? You stop thinking like a gambler. In bull markets, aggression is rewarded. In tightening cycles, survival is rewarded. Cash stops being trash. Cash becomes optionality. It becomes patience. The traders who survived that morning weren't the ones smashing market buy orders. They were the ones who had reduced leverage weeks earlier. The ones who noticed stablecoin supply shrinking. The ones who understood that thin liquidity is a warning, not an opportunity. This isn't about being bearish. It isn't about predicting doom. It's about recognizing regime change. The rules of 2024 and 2025 were built on cheap money and expanding balance sheets. 2026 is different. The gravity has increased. Every rally faces resistance. Every dip lacks depth. The $40 billion wipeout wasn't random. It was mechanical, a stress test that revealed cracks in the system. And cracks don't fix themselves overnight. Right now, most investors are staring at price, hoping for green candles. But price is a symptom. Liquidity is the cause. There is a specific indicator professionals track, a liquidity heat map that shows where bids cluster and where voids exist. Days before the crash, that heat map showed an air pocket beneath $51,500, a gap where buyers used to sit. When price fell into that pocket, it dropped fast. And today, that same map is flashing another void lower down, a second air pocket. If price drips into it, the cascade could repeat. You need to see that chart. You need to understand where the market is hollow and where it's supported. Because in an environment like this, it's not about predicting the future. It's about avoiding the trapdoors. The February crash was the warning. The next move will be the test. On OG John X.X, we don't chase hype, we read structure. And the structure right now is fragile. Click the next video. I'm breaking down the liquidity map in real time and showing you exactly where the next flashpoint could trigger. Don't wait until another $40 billion disappears.